Artificial intelligence isn't just transforming tech, it's creating a hidden boom in real estate. So while markets chase AI headlines, savvy investors are eyeing the small and mid-cap space. From data center REITs to public and private real estate growth not seen in decades, where is this market going? We're going to discuss that right now on UBS Trending. Hi, everybody, and welcome to another episode of UBS Trending. I'm Anthony Pastore. Thank you for being here. My guest today is Paul Baiocchi, Chief ETF Strategist with SS&C Alps Advisors. Paul, good to have you in the studio. Good to see you.
Good to see you in person this time.
Yeah,
Anthony.
exactly.
Yeah.
We've only ever done the virtual one, so nice to have you in from the West Coast. Well, sort of almost West Coast, Colorado area. But great to have you. Listen, I think given what you are covering and what you're talking about, it's a really good time to be here to discuss what's going on. So I wanted to kind of start with REITs because the REIT market is so interesting right now. We're in this lowering rate environment. The Fed is expecting to be cutting probably, according to our chief investment office, another 125 basis points between this next Fed meeting and next year. So where are you seeing the most opportunity in REITs, and what does that look like right now for investors?
Yeah, so we've had some head fakes in REITs over the course of the past year. So you go back to fourth quarter 2023, and REITs were the best performing sector in anticipation of what the market was pricing in at that point, which was 5 or 6 rate cuts for calendar year 2024. And then early on in 2024, as you remember, we had hotter than expected inflation, maybe sort of re-acceleration, if you want to call it that. Odds of rate cuts went down. And then in the middle of the year, we started to get inflation data, whether it was PCE, CPI, or otherwise, that was more in line with what the market was expecting, and that was signaling that the Fed was going to start cutting rates. And then REITs started to wake up again, and we did get the 50 basis point and now another 25 basis point rate cut from the Fed. And historically, REITs have been a sector that is cyclically oriented, is sensitive to the interest rate backdrop. And if you look at history, and history doesn't repeat itself, but it often rhymes, REITs do tend to outperform on the back of the end of a rate cutting cycle and into an easing cycle. Yeah. And so when you get the head fakes and inflationary data and changing or moving targets as it relates to what the Fed is expected to do, that does wreak havoc on REITs. But the setup, to your point, based on rates and some of these sort of secular trends in the economy, we think are a nice setup for REITs.
Yeah, and I think that's a great way to start. And we're also talking about artificial intelligence all the time, from how it not only impacts the tech sector like that Magnificent Seven, but those adjacent sectors like energy and particularly real estate. You've got all these data centers that are needed to run these giant mainframe machines to keep AI going. That must be putting some kind of excitement into the REIT and real estate space.
Without a doubt. And if you look at some of the adjacencies, like you said, energy is certainly one of them. Utilities, third best performing sector this year. Yeah. A lot of that is re-rating in anticipation of increased electricity demand coming from data centers, specifically tied to this infrastructure investment that the hyperscalers are deploying. But I would say the REIT story is sort of lost in the shuffle because it hasn't been one of the leadership categories in the market on the back of this AI trend. And I would say if you look at S&P 500 real estate companies, there is a big footprint in industrials and data center REITs that are tied to this story, that have 2.5 year backlogs tied to the investment that we're seeing from hyperscalers. And Sam Altman from OpenAI said recently he wants 5 gigawatt data centers. I mean, that's a massive amount of electricity.
That's right.
You're talking about more electricity than countries demand. And so you just try and think about, okay, you can play this directly with the big hyperscalers and with the chip stocks, but certainly there are going to be other beneficiaries of this. And public REITs have a disproportionate exposure to data centers and to some of these trends than, say, the public side, or the private side, I should say. And unlike the private side, a lot of these public REITs have been trading at discounts to NAVs and have maybe some fundamental characteristics that are more attractive than the private side.
Is that what's driving that gap between public and private real estate investments? Is that what you're talking about here?
Well, I think on the private side, naturally, there's a lack of sort of day-to-day pricing. And so you don't have as much clarity around the day-to-day, minute-to-minute, tick-by-tick prices of these securities. And there's also been some gating on some of the large private REIT strategies, people trying to get out who haven't been able to necessarily get out. And those people who have liquidated their private real estate positions are looking for similar exposure and are now looking for options in the public space. And there is a different exposure in a public REIT portfolio than there is in a private. They can be complementary. There isn't a lot although most people associate commercial real estate with the REIT story,
Right.
there isn't really a lot of commercial REIT exposure in your typical public REIT portfolio.
Right. Yeah. We definitely are looking quite extensively at the commercial real estate side. I think a lot of people from the pandemic to today are looking and seeing where there might be opportunities, given office space is not quite what it used to be. But we were just saying some companies are moving to a more in the office kind of. I think Amazon just moved to 5 days a week, or they're expected to move to 5 days a week. Some of our competitors are 4 and 5 days a week. So that could adjust maybe the picture of commercial real estate going forward.
Yeah, and there's some noise in that data. So the Castle Index, which sort of measures in-office activity, hasn't quite picked up to the extent that maybe some were predicting. To your
Right.
point, there are large organizations in the country who have big commercial real estate footprints who are asking people to come in either 3 or 4 or 5 days a week, and that does have an influence. But the reality is we're still working through this massive debt wall in the
Yeah.
commercial real estate space. Hundreds of billions of dollars this year, next year, the year after. And so I don't know that 75 basis points or even another 125 basis points is going to be a panacea for what ails the regional banks that have exposure to the commercial real estate market and the commercial real estate market itself. And so I do think that investors who are thinking about real estate, think about public REITs and where you have exposure, which is industrials, data centers, specialty REITs, healthcare REITs, and cell tower REITs, which is very distinct from what ails commercial real estate.
Right. So let's move over to kind of the small and mid cap space, particularly small caps. Yeah. I think there's been a lot of talk about small caps because they have sort of underperformed the large cap S&P index. Right now here at UBS, we have an attractive view on large caps and a neutral view on small caps. Although we do see that they could benefit obviously from these Fed rate cuts. I think our analysts are kind of still concerned about profit growth lagging a little bit in the space. But what do you think? What's the case for small caps right now?
Yeah. So there's the valuation story, which I think a lot of people have covered ad nauseum.
Absolutely.
You look at the PE ratio on the S&P 500 versus the PE ratio on the Russell 2000. The spread there is about as wide as we've seen in 30 years, going back to the dot-com bubble. Now, I would argue that a PE ratio on an index like the Russell 2000 is inherently flawed because there's 800 companies or so in that Russell 2000 that aren't profitable.
Right.
So they don't make it into that
A
calculation.
lot of floating rate debt in there, right?
There is, absolutely. There's also, if you just divide the S&P 500 by the Russell 2000, that spread is as wide as we've seen going back to the dot-com era. So
Right.
the valuation setup is part of the story. The fundamental setup, like you said, earnings growth on the Russell 2000 and the small and mid-cap space is expected to exceed the S&P 500 just at the index level. If you look at a quality orientation of that, it's expected to surpass the S&P 500 by a significant margin. So what we're advocating is you've got the valuation story, you've got the fundamental story, and then you've got the cyclical story. Historically, small caps do well when you're coming out of a hiking cycle akin to what we talked about with REITs,
Sure.
into an easing cycle. Some of the policy proposals from the incoming administration are certainly oriented toward domestic companies, which small caps tend to be. But importantly, we also don't think you can just naive cap weight the small and mid cap space. There's a lot of peril. You talked about 35% of the debt load is floating rate. There is a lot of leverage there, a lot of unprofitable companies. So if you just filter it down to profitable companies without leverage who grow their dividends and cover their dividends, you can sort of insulate yourself from some of the worst outcomes.
Yeah, right, exactly. And back to the AI story, which we can't really escape these days, there are a lot of, again, adjacent companies within the small and mid-cap universe that play in the AI space or adjacent to AI.
Without a doubt. And I would also say that the house view may be neutral on small and mid caps, but it is typically a fundamental part of an asset allocation. What that level is or what that allocation is depends, I think, on the outlook, but there is sort of a durable allocation, people within an asset allocation, diversified, lend to small and mid caps.
Right.
And so then thinking through how that allocation looks now and into the future and the best way to approach it is how we're thinking about it. So you've got the three legs of the stool: valuation, fundamentals, and sort of the operating macro backdrop. But you can't necessarily just say, okay, fine, I'm going to buy the index here, because there are challenges with doing so.
Right. Obviously, being picky as far as what you're investing in and having that diversified portfolio is certainly key. We preach that pretty much every time we get on one of these shows and say diversification is key. So with all that information and knowing the cycle that we're in, especially where the Fed is concerned, what's the silver lining here, Paul? Where should investors be putting their money to work, given our conversation that we're just talking about here?
Yeah, so we've got a quality dividend-oriented ETF, OUSM is the ticker, which takes, like I said, companies that have strong profits, high ROA, don't have a lot of leverage, so low net debt to EBITDA, have grown their dividend over the past 5 years, and have well-covered dividends. So in theory, what you're doing is taking this universe full of a lot of different companies with a lot of different risk profiles, 9% of the Russell 2000s in regional banks, avoid some of those worst outcomes in terms of ensuring that the companies you own generate profits without excess leverage, grow a dividend, and have well-covered dividends. And in just terms of being able to sleep at night, being able to tiptoe, if you will, into small and mid caps without the sort of full beta, full drawdown experience, full downside capture, that's really what we're advising advisors to do on behalf of their clients.
Excellent. Paul, thanks so much. A great conversation. Good to have you in the studio with me.
Always. Thank you, Anthony.
Yeah, great. Paul Bayaki from SS&C Alps Advisors. And thank you for joining us. For more information on anything we talked about today, there's a lot of information on our website, ubs.com/views. Plus, you can follow UBS on social media. We're on all the major channels, including Instagram. Follow us at UBS Trending. It's right there on your screen. And don't forget, if you have any questions, make sure you're contacting your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon.